natural gas, guys, is the perfect fuel moving forward. And even if we transitioned everything today, natural gas alone has 200 years worth of production that we could transition to. So no, it's not going away today or tomorrow, and no different than gold. They're both it's a fossil fuel. So it's, a finite amount, right? In which what keeps the value of oil and gold always high.
Welcome to the Cash Flow Fight Club podcast. I'm Mike Deaton.
And I'm Ligia Deaton. Together as co-hosts in life, business, and this podcast, we're matching up the heavyweights of cash flow creation to see who reigns supreme.
We do this so you can discover the best way for you to generate transformational cash flow and pursue the life of your dreams. So whether you're a side hustle seeker, full-time entrepreneur, or just looking to create job-quitting cash flow like we did, hit subscribe and grab your ringside seat for the most entertaining and informative investing show on the airwaves. Let's get in the arena.
Let's do it. Where would you park your investment dollars? Timeless, shiny, and desired gold, or black liquid fuel from dinosaurs, oil, aka black gold? In today's head-to-head Cash Flow Fight Club matchup, we are drilling deep, mining, you might say, into two epic investments that have literally fueled the world economy for thousands of years.
Ben Nadelstein is channeling his passion for macroeconomics into precious metals and unlocking new investment models that allow for not only appreciation from your holdings, but also to generate incremental returns on your investment. Ben's an educator on the value of metals through articles he writes, the Gold Exchange podcast, as well as speaking to individual investors about the power of gold and precious metals. Fighting out of LA, California, please welcome to the Cash Flow Fight Club arena, Ben the Midas Touch Nadelstein.
Yes.
And going up against Ben today is Rey Trevino III. Rey is representing his family business that his dad started, Pecos Country Operations. Their company is an oil and gas exploration outfit and operates wells and drilling operations across the south central U.S. They currently operate over 100 wells and add about 6 to 12 per year. Fighting out of Fort Worth, Texas, please welcome Rey, the Wildcatter Trevino.
Woohoo!
This is a fun matchup with two great gentlemen, and it delivers insights into how you can grow your wealth and your cash flow through two powerful investments, oil and gold. Let's jump into the arena and get ready to rumble! Guys, Ben, Rey, really appreciate you guys coming on the Cash Flow Fight Club podcast for an epic matchup with black gold and real gold. So,
the shiny version.
Happy to have you on.
I don't know. I think they both can be pretty shiny, if you ask me. I will say that.
That's usually how these things
has a good gleam to it.
Yeah, that processed crude. Yep, definitely. Well, we appreciate it. This is going to be fun. So just a quick rundown reminder of kind of how we lay this out. So 3 rounds. First round is getting to know you both, a little bit of intro, personal background, whatever you want to share. Round 2, we'll get overview of your business model, the ins and outs of how things work, how people can make money investing in your business and your investments. And then round 3, we'll go a little deeper. We'll talk maybe some things we haven't covered in round 2, risks, taxes, whatever you want to bring up. Then we'll crown a champion, and that'll be it. So with that, let's dive right in. Mr. Trevino, let's start with you. Give us a little background. How'd you get into the oil business and all that?
Yes, no, thank you so much. First, Mike and Ligia, and I think I butchered it again. I apologize. But thank you all so much for having me on. Ben, it's so exciting to connect with you today. And a big fan of the Cash Flow Flight Club. I love this concept. You guys are just rocking it out with this. Thanks for letting me go first. Again, my name's Rey Trevino III with Pecos Country Operating. I work for a family office that we drill oil and gas wells for production for that monthly cash flow, and we drill those wells for tax deductions. We've been around in inception since 2011. I am proud to say I'm second generation oil. My father's been in the oil and gas industry since the late 80s. Right after the bust is when he got into it. So we can't complain. But on a normal year, we drill anywhere between 8 to 12 oil and gas wells. And we usually do that with our own back pocket. Every now and then we may bring in an investor here or there. But, we definitely look at assets that are already producing. And of course, the good old-fashioned term is wildcatting, and every now and then you do find an unproven area and try to go do all the research you can and go drill for new oil in new areas. And we feel that with our concept of taking the old and adding in the new, we do a pretty good job on an annual year drilling successful oil wells and bringing old oil wells back to life. So, yeah.
That's great. And did you mention you're a Texas guy? I don't know how many generations back, but
I am. You know what? That's funny you mentioned how many generations back. We did the math on that just the other day. We're actually proud to say that we're 6th generation Texan.
Nice.
And so very, very proud to say that. We are here in the good old North Texas area. So shout out to the Dallas Cowboys. One year we'll get back to the Super Bowl, I hope.
Oh, don't say it. I'm a Fort Worth native myself. So, I got the silver and blue in my blood. I've been trying to ignore it since the 90s, but
yes,
we'll go away. Good stuff. Thanks, man. Ben, how about you? Give us a little of your backstory and how you got to Monetary Metals.
Hey, thanks, guys. I want to say I'm ready. I brought my own gloves to the fight. I love the idea of this podcast. It's really awesome. Ray's going to be a great sparring partner here. I came to Monetary Metals kind of a weird way.
No gloves, man. This is bare knuckle.
Yeah, okay, you're right. Hey, listen, bare knuckle. All right. So I came to Monetary Metals kind of a roundabout way, if you could put it that way. I started off as a music guy, a performing arts guy. I sing, I dance, I juggle, I do anything just to be on stage and have people looking at me. And I one day got the economics bug, found a book with some interesting insights. Yes. And I decided I'm going to dive into this. I'm going to keep drilling for some of us in the audience into this and see what I can get out of it. And it turns out you can get quite a lot. There's lots of smart people out there who have, thought about this stuff before. And I've just been kind of mining those insights ever since. And when I was looking to kind of get out into the workforce, finally, I decided to switch from singing and dancing to learning about economics and finance, and ended up at Monetary Metals doing the gold and silver leasing as well as bonds, and been happy ever since. I'm the head of content, so I do podcasts, I write articles, and pretty much just talk all day about the things I love, which is making the world a better place through the monetary metals.
That's great, man. You found your passion and you're leaning into it. And I won't go down the road of which would be more lucrative. I guess if you're in performing arts, it can be very lucrative if you're one of the 0.1% that gets.
When I hit it big, I know it's going to be from this podcast. So if any talent recruiters are here, you can pick me up. I'll do them both.
Great, awesome. Well, you had something.
I was going to say, they got that giant show Yellowstone, and they were looking for people just a couple of weeks ago for actors. So I don't know those people or anything like that, but I'm just saying.
In the Fort Worth area, they're looking for actors. Yeah. Well, fun fact, I won't take us too far down a rabbit hole, but I went to school with Taylor Sheridan, who was Taylor Gibbler back then, the creator of all of that. So we were pretty close friends in 6th and 7th grade, doing dorky things like Dungeons and Dragons and whatever was popular back then.
Granbury or no?
They had some property out in Granbury. They had a ranch out in Cranfell's Gap.
Yeah,
and
very cool.
But he went to school in the Tanglewood area, Fort Worth, there where I was living.
Okay.
So, yeah, good stuff. It's a small world, man. But I'll be an extra. I think Yellowstone's done, from what I understand. But the spinoff is going, I think, with the others. But
they figured it out. I will say this about Paramount: I haven't seen the one company go all in on somebody since Fox did it with Seth MacFarlane a few years back. So
big stuff. All right. Well, anyway, let's back to the cash flow. Let's jump into round two then. I think we've already teased a little bit of where you both are in terms of gold and silver and oil. But Ben, let's stay with you, man. Why don't you give us a bit about monetary metals, gold and silver, and how you guys are flipping the script a little bit and working to allow people to generate actual returns and cash flow?
So when most people think of gold and silver, they think of a shiny pet rock, right? Just kind of sits there, collects dust at your house. It might be in a personal safe that you buried maybe, I don't know, 50 feet underground, and you hope that you never use it. Just kind of insurance that does nothing. And that's okay. I mean, having some insurance that does nothing is great, right? Having some cash in a safe locked away in case something bad ever happens, nothing wrong with that. But what we do at Monetary Metals is we unlock the cash flow opportunities from assets like gold and silver. The way that works is just like a rental agreement, which you have with any other hard asset, like a property, an oil property, land, or even real estate. The way it works is a gold and silver owner rents in a lease to a company that wants to lease or rent gold and silver as their inventory or their work in progress. That can be companies like jewelers, refiners, mints, bullion dealers, manufacturers, anyone who has an inventory or a work in progress that's in ounces of gold and silver. And the reason that they want to rent instead of just buying gold and silver is that A, precious metals are precious, meaning they're very expensive. So, having a supply chain of $10 million worth of precious metals is not out of the question. And that's obviously a large out-of-pocket expense. It can take up a lot of capital. Just, holding $10 million worth of jewelry or inventory of coins or bullion bars. So that's the first problem with buying gold and silver. And the second problem is that the price of gold and silver fluctuates daily. So you could have bought gold at, let's say, $2,000 an ounce, and it could have fallen to $1,900 an ounce. Now, as a jewelry manufacturer, your really only option to hedge that price exposure is to do futures betting. So you'll go into the futures market, open a contract, and try to bet that the price of gold will change. Now, that's mostly outside of the core competency of these businesses that just, do value add to jewelry, and they're not really speculating or hedging in the markets as their main job. This is something that they have to do to continue operating their business. So what we do at Monetary Metals is we say, let's ditch all of that speculation, risk, and hedging, and instead let's rent out your inventory so that entire supply chain from work in progress all the way to final inventory can be rented out. And then there's no price risk because you don't own the gold. And you don't have to worry about tying up working capital because, again, that gold is owned by someone else. You just pay a rental fee every single month to own the gold. Now, everyone's first question, wait a minute, if someone's using this gold to create jewelry or bullion products, what happens when they sell that final product, like a ring or a necklace? Well, the answer is they have that leased inventory, let's say 100 ounces. And when someone comes in to buy, let's say 5 ounces of jewelry, they simply buy 5 ounces and sell 5 ounces at the same time so that they're not exposed to the price. But they can remain liquid with that entire inventory amount and still pay and sell as much gold and silver as they need. So that is a way to kind of lease out their entire inventory or work in progress. And the difference is the rental fee is denominated in ounces of gold or silver. So most rental fee contracts are denominated in dollars, your local currency. And so if you're renting to a tenant, they're not going to pay in more square footage usually. But in a gold or silver lease, they actually are going to be paying in the same metal that you're leasing. So if you're leasing gold, they'll pay in ounces of gold. If they lease in silver, you'll be paying in ounces of silver. Interest rates range from 2 to 5% in those leases, and again, denominated in ounces. So with 100 ounces at a 5% interest rate, you would have 105 ounces at the end of the year. That's regardless of the price of gold and silver. That's our first product. It's called a fixed income product, and it's called a gold lease, which is just a way to rent out your gold and silver. We do have other products called gold bonds, which are for accredited investors only. They're private securities, but they do operate similarly to gold leases where the income is denominated back in ounces of gold, but the actual financing of the operation is a bit different. Gold miners want to finance their mining operation, but they don't want to do it in dollars because that dollar has a price risk to them, right? They're getting gold out of the ground, but they owe a liability to the bank in dollars. Clearly, there's a mismatch, right? At some point, they have to sell gold for dollars. And you can get in real trouble if the gold price moves against you. Now, again, there's these hedging opportunities and all these things that they could try to do, but they're expensive, they're costly, they're complex. And so what Monetary Metals does is offer gold bonds, which is a form of gold financing, matching that gold asset that they get out of the ground with a gold liability that they owe clients of Monetary Metals. So my clients would deliver gold. That gold is sold for dollars. Those dollars are then used by the mining company to buy equipment, more labor, hard hats, drills, whatever it may be. And when they get the gold out of the ground, they pay back in ounces of gold, the capital amount plus the interest rate. So again, similar idea. You have gold and you're earning interest on it every single month paid in ounces, but the bond and the lease have different risks and therefore different returns. That's a broad overview of how the company operates, how there's cash flow from gold. But the main benefits are there's no storage fees, there's inventory or insurance and reporting, depending on what type of product you're doing, and you get that monthly cash flow denominated back in ounces.
Yeah, thank you for that. I know we've talked it through a little bit before, and this business model can be confusing. I know it was for me at first, but I come from high-tech supply chain operations, and an analogy that I use is, there's an end-to-end supply chain for whatever, right? I worked for a manufacturer. We made mobile phones. We used all kinds of suppliers. We had from cardboard boxes to pack them in to semiconductors. Well, at some point, maybe 15 years ago, there was a movement to do exactly this, where there was third-party logistics providers that would come in and take over the supply chain, and they could do it more efficiently than the marketplace. Also take, as you mentioned, the capital risk out of the other players' hands, and they could use their capital to get better return on capital than investing in warehouses and labor and all that stuff. And so they would take a fee for doing this service, but it was invariably less typically than the manufacturers or the sellers could do on their own. Another analogy I think that may fit for this one, and Ray, you're going to have to check me on this, but like if you think about oil, there's a long supply chain, right? You're pulling it out of the ground like you guys are doing, and then there's all these downstream opportunities. Well, different parties can own different pieces of that whole pipeline, literally. And so that's kind of, it sounds like what Monetary Metals is trying to do is say, okay, we're going to take the hassle off of the two end users, right? The source and the end user. And we're gonna take over the middle section. We'll take the liabilities, de-risk it by making returns in the actual gold, so we don't have to do these transactions and figure out the ups and downs and the swings in the market, and just kind of de-risk a little bit of that and just take the fees. And those fees that are collected, it sounds like you guys collaborate with me or Ray or a user that says, hey, I have a certain amount of gold. I will feed it into the process here and take a cut of what you guys are pulling off of that, and then that in turn comes in the back to us in those metals, right? If it's silver, we get 5% extra silver each year, or if it's gold, 5% extra gold, and then we can sell it, hold it, do whatever we want to do with it. Is that kind of nutshell what we're talking about here?
Yeah, and another easy analogy would be if you have a car that you decided to rent to a friend or rent to a business, that car is still your car. The title of the car remains with you. You don't sign over the title generally. And when someone's renting it, they're just going to pay you just to use the car. They just needed to, maybe run their business or, pick up their girlfriend, whatever that may be. And that rental fee is just denominated in usually dollars every single month. And they get to use the asset, right? They're not betting on the price of the Kia. They're not saying, oh, I wonder, what the Tesla is going to be worth 5 years from now. They just need to use that as part of their business. And they pay a fee to use it, right? Same with gold and silver. These jewelry companies, for example, they're not betting on the price of gold and silver. They're just trying to do some value add, right? They have some gold and they want to maybe etch a beautiful carving in it or turn it into jewelry or a ring. They're not betting on what the price of gold and silver is. They just need to use some for, let's say, a 6-month period of time. And in that period, they would much prefer to not have to worry about the price risk and pay a rental fee. The benefit of that rental fee being denominated in ounces of gold and silver is that when the prices rise, yes, their rental fee is more expensive, but they're selling their jewelry for more. And when the gold and silver price falls, well, of course, their rental fee is cheaper, as is the price of their jewelry. And if it doesn't move, great, nice and simple, right? So they really are, like you're saying, putting on the price exposure to the individual that wants it. People who own gold and silver would like the price exposure of gold and silver and are not worried about day-to-day fluctuations, 2%, 5%, 1%. But for a business that has very thin margins, that can be a very big issue. And so you're changing the price exposure to someone who actually wants it while putting the actual physical item in a place where someone actually probably doesn't want it, right? At a certain amount of value, you might not want to hold gold and silver at your personal home or in a vault where you have to store it and pay for it. So you're just kind of swapping the things that someone does want and the things that someone doesn't want, and getting a win-win mutual exchange there.
Gotcha. So you mentioned on the lease version around a 2 to 5% return. I don't think I heard, or maybe you didn't mention on the bonds. What's the return profile there?
So the bonds are definitely a higher risk profile and therefore a higher return profile, and they're open for accredited investors only. Our latest bond has a 19% interest rate attached. So if you have 100 ounces, you're earning 19 ounces as that interest rate, again, because it's all denominated in ounces. But our first bond paid in the 12 to 13% range. So you can see double-digit returns in the bonds. It does depend on each bond. Since they're private placements, they're going to come one at a time, and you're going to decide, hey, is the risk to return worth it? But they can generally be in the double digits all the way down to even something like a 5% bond you could potentially see.
Okay, so a little bit of a range depending on the timing and the vehicles there. One other point of clarification: you mentioned storage fees for people that own physical gold. What do those typically run, if you know?
Yeah, so it really does depend. It depends how much gold and silver you have, and also the price as well. Sometimes, depending on where you're storing it, as the price of gold and silver rises, you will be paying more to store it. And that just makes sense for the storage company because they're protecting a more valuable asset. But it can be around 75 basis points per year, and that's kind of never ending. And one way to think about it is that you're having compound interest, but the opposite way, right? So if they eat 75% of your gold and then another little 75 basis points, another 75 basis points, 10 years from now, you're going to have a much smaller amount of gold than you started with. Versus when you're earning or not paying to store, you're at least staying flat if you keep it at home. Minus the risks or potential insurance costs. And then obviously with monetary metals, every month you can earn that compound interest and let it sit. So 10 years from now, the difference between someone who stored gold at home, paid to store gold, whether professionally or, somewhere in a private vault, or earned interest every single month can be very, very wide.
Okay, got it. All right, Mr. Trevino, you've been patiently waiting there. Tell us a little bit about the oil and gas business, the way you guys run it, and how the returns flow out of that.
Certainly. I'm trying to think of, first of all, was that 75 basis points like on an annual basis or on a monthly basis, Ben?
I believe that's annual, but it does depend on the provider, and also certain types of storage, like a safety deposit box, will depend, right? So they don't do it based on what's in the safety deposit box because theoretically they don't know what's in the safety deposit box. But of course, how much gold can you store?
Yeah. And to clarify, 75% basis points is 7.5%, correct?
No, so it'd be
0.75.
0.75.
0.75%. Okay.
Yep.
That's right. Okay. Thank you. And then on the other returns, that 20%, is that annual or is that monthly for the larger risk ones, Ben?
Yep, those are annual. Same with the leases as well. So leases are generally 1-year terms. Bonds can be obviously a bit longer, but those are annual interest rates, and they're fixed income. Okay. So they're going to be what that denominated interest rate is. So if you're getting 5%, it's going to be a fixed 5% interest rate.
Okay. Well, very cool. Well, I drill oil wells, and then I take the oil out of the ground and we sell the oil. That's it in a nutshell. So really, here in the last 18 to 24 months, what we've done is put together a couple of packages because we've been working with some outside firms that like to evaluate and bring in different investor groups, primarily accredited investors, no different than with the monetary metals. We definitely recommend that because, at the end of the day, it is an investment and it is risky. But what we are encouraging people to do is invest not necessarily in us, but in our capabilities to drill and, more importantly, produce oil from the ground. So for an example, we had a great package that we did about a year ago. We had 10 existing wells that we went in, we reworked, and we've drilled 3 of 4 new wells on that package. And the idea was that we sold what's called working interest. To be more technical, it's a non-operated working interest to individuals that wanted to come in and basically be unofficial operators on a 1,000 acre lease that has a total of 14 oil and gas wells on it. And so what that does is, as you can see, I'm with Pecos Country Operating. So we operate those leases. And what an operator is in a nutshell is a fancy word for general contractor. We hire the drilling crews, we hire the workover crews, we hire the crews that come move the pump jack on location, the ones that clean out these well bores. We hire the team that comes in and connects pipelines, or that then connects the pipe from point A to point B. However, being the operator means we have so much responsibility, and especially here in the state of Texas, we have a bond, and we have to take care of that, and we have to mind the environment and everybody around us. The reason why we are an operator is because we also have an exploration and production company that is technically the non-op on our side. And what we have found is no different than any general contractor out there that builds homes. Hey, if I'm operating my own stuff, I'm actually saving money. And what we have found is by operating our own oil and gas wells, we streamline and save on average 33% a year on the stuff that we operate versus the stuff that we don't operate. Now, getting back to our investors that we've had come in, and they're all great individuals. A lot of them came from the real estate world right now, and where they're used to that, maybe 12% is a great return for them on an annual year. And so they've come in, and really what we do is we like to only sell about 30% of that working interest. And the reason why is because me, myself, and my family, we own the other 70%. So believe me, those oil wells that we're drilling or reworking are very important to our bottom dollar that they produce, and they do very well. So that's been something that I do like. And also it's a model that I think we're very new at. I know back in the day when my father was just doing a lot of non-op, people were selling anywhere between 50 to 80% of that non-op working interest and only keeping 20%. And that doesn't bode very well. It's just like, well, how much do you really believe in what you're doing if you're only keeping a small portion? And one of my father's old rules is, hey, if it's making money, why sell it? So what we do is we bring in these accredited investors, and basically they're buying this non-operated working interest in the well bore itself and the lease around it, so that if there's any other wells that we drill, they have the first opportunity to jump in on those wells also. So it's not just well bore specific. And another reason why we have 14 wells is because in a form and fashion, we're not keeping all our eggs in one basket. You see a lot of times where people are going to drill one well and then go drill more. Well, what we have learned over years of doing this, that a lot of people, if they drill one well and it doesn't do good, then they're not going to go and be motivated to drill wells around that. So what we do is it's like, hey, it's a numbers game, because every now and then, yes, you do have a dry well, but you've got to drill the other wells to continue. And so that's how we've been able to build our business. And again, we live off the production that we produce every month. So right now, in this current venture that these individuals are in, they're already at over a 40% annualized return, gross annualized return on their investment that they made just about a year ago this time last year. So that's kind of what we do in a nutshell. And again, we're a family company, so we mail out monthly cash flow checks every month to these investors, to where it is true mailbox money for them. They don't see the journey that me and my team makes from the front door to the mailbox every day. But, we do take out the operating expense on a monthly basis. But again, we've streamlined it because we own the other 70%. So I'd be billing us just like I'd be billing our investors. And that's something else a lot like, it is a private placement investment, which I do recommend people to do, not go in with the Exxons in the stock world because, well, I would say do it if they want, but that's long-term, short goal, short annual returns normally. This is something that we're looking at that these individuals are going to see a return on their investment, not only for the first 12 months, but a typical oil and gas well can produce oil for 30 years. So they would see returns over a 30-year period for their investment.
Nice. And how is the investment? Like if we were to come and invest with you, is there a fixed term to start with, and then you allow people to just continue to stay in the investment, or is it?
As far as a fixed term, like for an example, we've got a new project, and we're going to start drilling those wells here late the end of this quarter. And once we started that drill, we will not allow anybody else into that project because for the main simple positive reason is when those new drills come online and let's say they do even more than we projected, our investors now have more value in that investment that they made. So why would I then ask somebody else to come in at the same dollar amount that my investors actually put their money in at a risk and they didn't know? Now, we do different funds, yes, absolutely, throughout the year, but we do keep them pretty separate.
Okay, so like as an investor, I would be investing in a set of equipment and benefiting from whatever the output of that equipment is over the life of that equipment.
Yes, and it would be really the well. Now the equipment and all that does come with it, but yes, sir. So basically, you got 14 wells in this current project. So you would be investing in those 14 wells, and you would be part of that for the lifetime of them, as long as you want to be a part of it. And you can exit it if you would like. But again, if it's making money every month and you don't have to get your hands dirty, why get rid of it?
Yeah, interesting.
Yeah.
All right. I think that gives us a good flavor for kind of what both areas are. At this point, we can technically enter into the round 3 section here, and feel free to ask each other questions as well and kind of probe what's going on here. Ray, maybe staying with you. Aside from the monthly cash flow and the overall net return, which is maybe that leads me into a question. So, returns are coming monthly from the output. Is there, let's say you and your family controlling interest decide we're going to pull up stakes. This is, I don't know, slowing down, or there's no output or something. Is there also a final, would there be a final larger payout from all of that, or it would just kind of, the investment would stop?
No, great question. Yes, we joke all the time because sometimes we're projecting some of I think even JP Morgan as of today is possibly projecting, or Bank of America, somebody that we could even see $150 oil here in the next 12 months. So, here I'm saying, why would we sell something? But hey, if something's up for sale at $150 a barrel, absolutely you want to put that on the market. And then what our investors would get would be whatever percentage they bought in, they would receive that percentage back out, and they would be able to exit the strategy. Yes. So, that is something there that they could do. But as of right now, there's no really look into anything like that. But yes, they would have that opportunity for an exit strategy.
So there could be a scenario where there's something outside of the cash flow. What about taxes and depreciation?
Yes, great question. That's actually why we got into the industry, was for the tax deductions in the beginning. In the 80s, my father was a W-2 earner, had his own business, but he was a high-income W-2 earner. He wrote custom software, and he started writing custom accounting software for 3 of the biggest families over in Fort Worth, and oil and gas families, and he was writing it for their accounting. They were bringing their accounting in-house. So he was writing custom software. And in the 1980s, custom software was not cheap. So all of a sudden you had this big crash, And on the news and the media was saying oil and gas is dead. It's over. And so my dad is going, you know what? I know how much value I have in my software. I'm not changing my prices. Well, like clockwork, my dad continued to get their checks every month. And it was like, I'm hearing all the bad things about oil and gas. What's going on? So he always jokes going, I must have asked that question out loud, because as soon as he asked the question, somebody heard him and goes, Ray, my dad's name's Ray also, he goes, you want to come out to the oil field and see what we do? And he was like, yeah, I'd love to. And so he had to go buy a pair of steel toe boots, and he went out the next day. On the way out there, he got to hear this whole family's generational story. They were already on third generation oil. They were drilling on their own land, so they had their own minerals. And so on the way down there, Dad's enjoying the story, but he's like, well, there's no way I could ever get into oil and gas. Obviously, you got to own the minerals. You got to own the land to drill. And so he looks out, and on the way back, they go, and by the way, you know, all that tax stuff that you're working on helps us save taxes every year. And he goes, what do you mean? He goes, well, the IDC's intangible drilling costs, you can write off up to 80% of those costs when you drill a new well every year. And in some cases, you can do 100%. And Dad's like, what? And he goes, yeah. And he goes, well, that's awesome for you guys that y'all can do that. And they go, well, anybody can do that if you invest in non-op working interest. And my dad was like, well, where do I sign up? And the family was so close and like, well, not with us, but we can point you in the right direction. So really what you can do is write off up to $100,000 clean and clear on your investment. And then since it is a depleting asset, you can write off up to 15% of the income that you earn every year on that oil and gas. So in our perfect world, when we look at drilling new wells, we look at getting our investment back in 12 months, guys. That is the goal. So here we are in the first quarter. If we had an investor come in January 1st, 2024, they invested, $100,000 with us, and they started receiving payroll for that month one. And they earned $100,000 over the next 12 months. That means on their 2025 taxes, they'd be able to write off the $100,000 investment and write off $15,000 of the $100,000 that they earned throughout 2024. So in a way, you could almost say it's 115% write-off, but I'm not going to say that. But then also, again, if you invest over $100,000, you can still write off up to 80% of that investment that you made. So that's how he got started into it. And in 2011, when we started taking larger chunks of non-operating investments in oil and gas. And then in 2019, we started operating our own. So that's really one of the best things that we like about oil and gas is even if the well is successful, which is our goal every time we drill a well, you can write that investment off.
Yeah. It's amazing. We haven't benefited from oil and gas, but we love real estate for that very fact, right? You just kind of get to do that.
And the minimum investment with you guys is $100K?
Usually we like to do that every now and then if somebody is different, because my dad talks all the time, and it's like we didn't start out writing $100,000 checks in the 1980s to invest in oil. So, everybody has to start somewhere. And again, it is a private placement, and we do prefer accredited investors, and, got to make sure that, hey, it is an investment that you could lose, but again, you would write it off. And, right now, again, as I was saying earlier, as far as returns go, our goal is to get our investors their money back, and more importantly, our money back in the first 12 months. So on a typical well, our investors can see somewhere between 7 to 10 times their initial investment back over the lifetime of that well. And usually we see 5 to 7 times that initial investment back in the first 7 years. So usually, obviously, with any kind of depleting asset, you're going to get the bulk of your investment back first. However, then you've got still long-term mailbox money. And the idea is, hey, you've done enough of it that you still got a great check coming in every month in 20 years.
Love it.
Great.
Mr. Nadelstein, how about on the metal side of things? Taxes, depreciation, even to Lidge's point, maybe what are some of the minimum points to entry other than having your own gold? But
So I'll start in reverse, which we'll start with the minimum account sizes. So it's 10 ounces of gold, 1,000 ounces of silver, or the dollar equivalent for those who don't have gold or silver. You can also mail in gold and silver you already own. So let's say you have some grandma's bullion bars or something in the basement. You can mail those in. Not jewelry. Obviously, that's not a bullion product, so a little bit hard to melt down, your mom's necklace or whatever. But 10 ounces of gold, 1,000 ounces of silver, or the dollar equivalent, which is right now about $20,000. Obviously, the gold price changes daily, so $20,000. And one thing just to mention for those gold bonds, those private placements, those are for accredited investors only, but the gold leases and the silver leases, those are for anyone. So you do not have to be an accredited investor. You just need to have the account minimum size. So a little bit easier to get into. If you have a couple of silver bars or gold bars lying around at home, you can keep obviously some at home if you'd like, and then put some into some leases or bonds if you'd like, depending on your investing status. Now, in terms of taxes, very simple. Interest income is taxed as interest income. So you'll get a 1099 at the end of the year. We'll fill that out for you. It'll say, hey, here's the dollar price of the gold interest you earned. It doesn't say how much gold you have or the ounces or anything like that. It'll just simply say, hey, let's say you earned whatever, $400 in interest income in that fiscal year, and it's charged and taxed as interest income. Now, depends, again, talk to an tax expert, which I am not, about the taxes on gold and silver in terms of buying, selling, but I do not believe there are any kind of benefits there in terms of depreciation. I unfortunately not. And if that does change, I will be the first one to let you know. And that's kind of the main benefit there, I think, is not about the taxes, but I think about the hedging of the currency. And I'll jump really quickly into that, which is that, you can look at all of these investments that you have, whether that be oil, whether that be real estate, whether that be the stock market, dividends. At the end of the day, although there are diverse ways of getting cash flow, it's the cash flow that is all one thing, which is denominated in your local currency. So let's say you live in Argentina, you might have, stocks, dividends, you might have real estate, rental fees. But at the end of the day, you're getting the peso, which is really not that great of a currency, right? And it's the same with dollar investments. At the end of the day, you are getting a dollar income back. And depending on how the dollar does, either compared to global currencies or compared to gold, you can be losing value over time. So when Ray's father probably started out, $100,000 check would have been truly incredible and a big thing to write. Now a $100,000 check is potentially doable, not even for, incredibly high net worth individuals. So just over time, thinking about the value of the cash flow that you're getting, right? I mean, if someone was said, hey, I'd love to pay you this cash flow in Argentinian pesos, that's probably not really a great deal for you, right? So just thinking about hedging, not only in terms of market risk, so you don't want to be kind of correlated with real estate if you're heavy in real estate, or correlated with oil and gas if you're heavy in oil and gas. You might want some asset to kind of counterweight or counterbalance the rest of your portfolio, but also what that portfolio is denominated in could also probably use a hedge as well.
Yeah, that makes sense. I mean, definitely precious metals in general, but gold has been talked up as a great hedge against all of that, which kind of pulls me into another topic, risk on these. And so help me understand on the metal side of thing, where does the risk lie for me as an investor? Like if either I send you gold or I sign up for a lease or a bond, what's the risk if there is any there?
Absolutely. There's always risk to every investment. If someone doesn't say absolutely there's risk to every investment, you should run as fast as you can, because there's no such thing as returns without risk. And let's kind of quickly dive into the risks here. So first, in terms of shipping the metal, there are obviously things that can go wrong. Someone can lose it in the mail. We do insure the metal if you're shipping it from the United States. So, someone loses it or breaks it or whatever it may be, that will not be on you. That's in terms of getting it to us. Now, if you just wire us cash and we buy the metal for you and you say, hey, I'd like to do a lease, I'll walk through the risks there. So a lease is a rental agreement, just like other rental agreements or lease agreements that you've probably signed as a real estate investor. And you will see in each lease agreement a slide deck explaining the cash flow, the risks, the insurance, the inventory reporting. And since we're not a bank, you can decide, hey, I'd like to invest in this or not invest in this lease. And it's totally opt-in or opt-out model. one of the benefits that we do to kind of diversify your risk across our different leases is we put your ounces in all of our different leases, so you're weighted across all of them. So let's say you would have 1 ounce in a jewelry lease, 1 ounce in a bullion lease, 1 ounce in a refining lease, but you would also have them in different jurisdictions. So you might be in Dubai, you might be in Ohio, you might be in Turkey, you might be in Europe. So you have all of these kind of different ways to diversify your risks against the different leases. And in each lease, you'll have things like insurance, inventory reporting, and also depending on the business, they'll have their own type of insurance to stop things like theft, loss, damage. Just like you would have a tenant who's going to have their own rental insurance, and you might have insurance on your property yourself. So that depends on the lease. And then at the end of the day, we also put your ounces into all of our leases to diversify your risk. And you can always opt out of leases that you don't like. Bonds are a little bit of a different story because, again, they work differently in the way that they finance. I'll jump quickly back to the leases. The title of the gold remains with you, and it's always in physical form. The same way that if you rent a car from Hertz Rental Car, the title is always with Hertz, and the rental car hopefully always remains in physical form, right? You're not selling the rental car at some point. And so that is one benefit, right? If that lessee or that jewelry company, let's say, goes bankrupt, that asset is not on their balance sheet, right? They can't say, oh, well, we've got $1,000 worth of gold. We're going to sell some of that to try to pay off some of our creditors, because the title of that gold is not with them. And, the lost payee is the client of Monetary Metals. So that's something that's important to know. It's a rental agreement and the title remains with you. That is a very important factor to remember in the leases. Now in the bonds, things are a little bit different because your gold is actually sold for dollars, right? And so you have gold as a physical metal, but it's sold for dollars to finance this mining operation. And you have the promise of that mining operation to get gold out of the ground, plus that interest income. So the risks there are really twofold. One is, of course, that the mine does not get gold out of the ground. And something similar probably to how Ray operates his business is that, you're going to aim and shoot for only business models or only mining operations that are either currently producing oil or producing gold, or need that final capital injection to produce gold or produce oil. So that's the first thing, is just we're picking business models and picking mines that we think have a very high probability of producing gold or already producing gold. And then the obvious second risk is just the jurisdiction. So if you have a jurisdiction in Australia, that's going to pay a lower interest rate and have lower risks versus a jurisdiction in Africa or Turkey or Dubai. Those are going to have higher risks, whether that be, war, conflict, imports, taxes, things like that. And so therefore a higher interest rate. So those are the main risks there, is that you have different jurisdictional risks and different mining risks. Those are not as present in leases simply because of the insurance, the inventory reporting, and of course the fact that your gold is always physically present and the title remains with you.
Right. Yeah, that's what I was trying to understand, because it sounded like the risks were super, super minimal and allocated really to what you mentioned, like, okay, something happening in the mail or something there. But I guess I can see with the bonds, you're actually taking an extra step there. So you are more...
Yeah, and I think the main risk with those leases, which is obviously technically possible for sure, is that in between something like inventory reporting or in a gap with the insurance, someone takes the gold and flies it out to a non-extradition country. That's definitely technically possible. And obviously we're going to do our best to make sure that that doesn't happen, that the business model is legit, that we get all these different assurances that doesn't happen. But at the end of the day, there is always a risk to every investment. And so, you have to make sure that matches your preference. And which is why in the beginning of the episode, I did mention, it is probably good to have some gold at your home or, in a personal vault somewhere, or even a professional vault, even though it does cost you basis points every single year or, collects dust. At least you'll have it on you, right? You'll have that personal protection. You'll have that insurance on you. And there is, in some ways, no counterparty risk, which is one of the benefits to gold that isn't present in some other types of investments.
Gotcha.
I do have a quick question that comes to mind. If I'm a potential investor with you guys, with your company, and I want to lease, I want to enter in a lease agreement, and I'm buying gold from you, and I lease it. And if something happens in our lives, we want to exit, opt out. Is that a possibility, or is my account locked for a certain time?
So it's a two-part answer, which is that the leases are 1-year terms, the same way you might rent a car. But we do have many clients who would like to probably be in your lease and allocate ounces to it. So, probably we would be able to swap you out. I never make promises or say, oh, yeah, you can definitely do it. They're not super liquid investments, right? They're not day trading. You're not swapping in and out and getting gold. But if someone said, hey, listen, there's a death in the family, or my kid's going to college, or, I just want to send Ben $100,000, you probably could get some gold out of that lease, sell it for cash if you'd like, or, have it physically delivered back to you as a Boolean product. And then you could, liquidate either a portion of your investment or the entire investment. That definitely does depend. Obviously, bonds have longer durations. And again, that could be a possibility where someone would like to take your allocation. But just be aware that the way the leases work is that since they're usually on a rolling basis, every time someone does a lease, the 1-year term will come up and they say, hey, we'd like to, roll that lease again and enter into another agreement. You have the ability to say, hey, you know what? I'm thinking I might need some liquidity. I may need some cash. I may need some capital in the next couple of months or so. I'm going to not do this lease. And then you would just have cash or dollars wired to you if you'd like that. Or, of course, the actual Boolean product could be shipped to your home.
Makes sense.
Yes.
All right. Ray, how about on the oil and gas side? So I think on the gold side, it seems like at least as far as the fluctuations in the market, those are minimized. But oil, I think, has this perception of something being a little more erratic, right? You have highs and lows, and what happens?
That's always the misconception. Like, for an example, in 2020, we had that little flu thing go around, right? COVID.
I think I remember that.
Yeah. And, that was the first time that, one thing I'll also say is I always joke with my dad. He's like, I've seen this before. Don't worry. I got this. Because there's always these highs and lows. And the important part is if you can continue to just ride the wave, and be consistent. So when we saw negative oil, I said, you ever seen this? He goes, no. Well, during that time, you saw so many families get out of oil and gas, or, a lot of companies just go under. We actually grew 3 times the size of we were during 2020 because of the opportunities. So here, on the news, you saw negative $37 oil. Well, we were still selling oil at the prices of $25 to $30 a barrel during that time frame. It was a time when I really realized that I had individuals that were on the sales side of the oil and gas or the service side that truly didn't understand the operating and the production side, because they were literally saying, give me your oil, I'll pay you rather than you pay me. And I'm like, I'll sit on my oil before I give it away. So we do our best to really kind of stay as consistent as we can. And when you bring in inflation, when you bring in the value of a dollar, and you kind of put that and equate it, and you kind of look at oil from let's say the 1940s to today, the price of oil has actually stayed pretty constant at $41 a barrel. So at today's rate of about $80 as we record, maybe high 70s, that's a pretty big win. So if we can produce oil for less than right now, I'd say $40 a barrel, then we are doing very well. So we do our best not to get too high and too low on the price of oil, because for a great example I can give is, let's say today, we've got a well that's doing 1,000 barrels of oil a day, and we're at $80 oil today. So we're making about $80,000 a day in oil. And then let's say, in a year from now, that well goes down to 500 barrels of oil a day. But oil, for whatever reason, has shot up to $160 a barrel. Guess what? We're still making $80,000 a day just based off the price. So we do our best to really kind of play them. We work with the midstream companies, and we're always fighting for the best price that we can get. Because as you talked about, there are 3 sides: the upstream, the midstream, and the downstream. Exploration and production's on the upstream, meaning it's coming up out of the ground. And then I sell it to the midstreamers, which are basically the supply chain or the logistics to get it to the refineries, who then are the downstream that have turned it into your Pennzoils, your motor oils, and things like that, and your gasoline. but also obviously, when we're looking at returns of anywhere between 40 to 100% in just 1 year, obviously there is risk that is involved in oil and gas. The biggest risk we have is when we really drill new wells and whether or not we may or may not hit a successful oil and gas well. And sometimes an unsuccessful well may be a well that we thought we were going to get 100 barrels a day out of it, and we're only getting 20. Well, we're still going to produce that as long as it's economically viable. And then the way we hedge against that is by picking up these older wells, reworking those, and increasing that production also. So usually, for an example, these 10 wells on the project that we had with a group, we planned for those 10 wells to produce just as much oil as the 4 new wells. Because like I said earlier, new production's always bigger. And so even if, let's say all my 10 wells came online, reworked, did great, and all 4 of my new wells were dry holes, at least we'd be at about a 50% return in year 1. That'd be, but again, we do have some cases where maybe those reworks may not do as well as they can. So worst case scenario is for us, yes, an investor invests with us, everything doesn't produce. And at the end of the day, they have a tax deduction write-off that they can use. But again, that's not the name of the business that we're in. We're here to produce oil on a monthly, daily basis, not only for our investors, but for us as well. So that is the biggest risk that we have. But again, our goal is to get somewhere between 60 and 100% of our returns back in year 1 on our new investments. And as we've compounded this since 2011, and even before that, we do a pretty good job every year of drilling new wells and continuing to produce oil for our investors.
Ray, is there a situation in which an investor could lose all their money? Like you put in 100K and it would go of I guess it would be dry. Well, you're obviously expending on the operating costs as a part of that investment. And I guess if you
great question. We do a lot with our investors, what are known as turnkey projects. So all the drilling and the reworks that are up front, that's already paid for. So all the operating costs that come later, as far as, you got to get your pumpers out there. Maybe you might have to add some chemicals, electricity costs, insurance costs, things like that. Yes, you're going to have that on a monthly basis. But the actual drilling of the well and seeing how much we produce, that actually comes turnkey to the investors. So we're not asking them for more money. Let's say we've drilled 2 of the 4 wells. I'm not going to go, oh, hey, I need more money to continue drilling. So that's one way that we hedge against with our investors. Like, hey, this is turnkey. We're not going to ask you for another dollar as far as the development of this lease is concerned. But again, the worst case, is that we don't produce oil and that their $100,000 investment, they never receive a dime back off their investment. That's the worst case. However, we make the argument, I guess, of, hey, but you can at least write it off against your capital gains or your general W-2 income.
Sure. And Ben, similarly for you, is it? I mean, it sounds like it's highly unlikely outside of some theft event or something.
Yeah, I mean, I would be interested in this one point for any economics nerds. You'll be very interested, which is something called declining marginal utility. And Ray brought it up, that other commodities other than gold all have a pretty steady or some drastic declining marginal utility, which means just having more and more and more of it isn't actually good, right? Like having a glass of water in the desert is great, but having 5,000 is probably not so great. You got to carry it, right? You're like, what do I do with all these? And like Ray mentioned, with oil, there can be a declining marginal utility depending on the user, right? With negative oil, they were literally paying people to store the oil because oil is toxic, flammable. If it's exposed to sunlight, not great things happen. And having the value of oil, it could be 10,000. And you'd probably know a bit better than I would about how much the value to weight aspect is. But for something like gold, you can carry $10 million of gold in a suitcase, briefcase, backpack. And so the carry costs are generally pretty low. And so, yeah, that does change the kind of the negative risk, right? Which is that there's probably never going to be a time where someone says, "Hey, I'm going to pay you all this money to get this gold off my hands," other than maybe something like a vault, which is just more of an insurance option. Now, in terms of what could happen, in terms of price, there has never been a time in 5,000 years of human history where gold has not been valued. So I'm gonna take a pretty solid bet there that things continue to remain. As history
Past
shown,
performance is not an indicator of future returns.
It's not 100%, but it's definitely closer to an economic constant than any other commodity or asset that we have in this world. And I guess my question for Ray would be like, what and as an expert in this field, do you think that there are kind of like regulatory and regime change aspects? I know there was a federal kind of pause. I think it was a 60-day pause on oil and gas leasing. Do you see that being a problem? Like, is Ray Trevino, the fourth and fifth, still going to be doing oil and gas? Are they going to be solar people? What do you think?
No, yeah, Ben, great question. And I actually do have a fourth, and he's two, but we call him Duke. And that's his nickname is Duke. And great question. That's why I loved this matchup, because no different than, gold being around since the beginning of time, there have been tar pits since the beginning of time. And what we've learned is these tar pits were ponds of oil that we had, and so they've both been a great commodity since the beginning of time. So I was so excited. I know we had tried to do one before, but this was just genius black gold versus real gold. It is a declining asset for sure. And a great question, Ben, about those liquid natural gas permits that this administration just pooled. I actually did an interview about this a couple of weeks ago. It's going to hurt the economy long run more than it is going to hurt the oil and gas industry. Right now, we've already got several facilities that we're building for liquid natural gas along the Gulf Coast, whether it's the Gulf of Mexico, whether it's, here in Texas, Louisiana. And so those can't be stopped. However, with this pause, we can't add any more new ones for at least the next 60 days. But what that also hurts, guys, is our economy here in America and the global economy, because our allies in Europe need that liquid natural gas just as much as we do here. Now, the cool part is they actually need it more there in Europe than we do here. Here in West Texas, we drill oil and natural gas just comes out of the ground just because. So, us to get it out, we are the Saudi Arabia of natural gas. So right now, this administration is going to continue to fight. And I have my own podcast and I actually film it here. And a quick shout out to the Real News Communications team for allowing me to host with this wonderful event at their studio. I had on some experts that, hey, they're fighting this administration right now because not only for the oil and gas industry, but for Americans as whole, because who we kidding? As oil and gas goes, that's our national security. So we're not too worried about what this administration's doing. Do I believe everything he says? Absolutely. He came in saying he's going to shut down oil and gas. He tried to do it. Inflation went up. The value of gold went up, if I'm correct, when inflation went up. Is that correct, Ben?
That is correct, yes.
And not only did that go up, but the price of oil went up. And he shut his mouth on oil. Why? Because we needed the oil and gas to get us out of this inflation that we were in, the high inflation. So, no, I'm not worried about it. Oil and gas is getting back to it. Oil and gas still has 100 years. Natural gas, guys, is the perfect fuel moving forward. And even if we transitioned everything today, natural gas alone has 200 years worth of production that we could transition to. So, no, it's not going away today or tomorrow. And no different than gold. They're both it's a fossil fuel. So it's, a finite amount, right? In which what keeps the value of oil and gold always high. One thing I always like to joke about is here in Texas, they always talk about, we need to succeed, and have our own currency. Well, I don't know how strong and how viable. I'm not in economics, but, we could definitely create our own currency and have oil back it here in the great state of Texas. And it would be valuable throughout the world. In fact, go down a rabbit hole. There's a group called BRICS, which is Brazil, Russia, India, China, and Saudi Arabia, they are trying now to get an oil-backed currency and devalue the dollar. But that's a whole other story that I don't want to get into. But oil and gas, yeah, no, it's not going away anytime soon.
I did have one more question. If you'd be nice enough to answer, what about a global investor? Let's say I live in Spain or I live in Europe. Can I invest in these oil and gas leases, or is it open only to American investors?
I will say this: one racist color nobody's ever bid against is green, which is $1. So as far as that goes, I've never had any international people ask to invest. However, I do know that we always hear about stories, and as long as they're doing it, you ask about regulations. As long as they're following the rules and regulations, no, I don't. Everybody wants to get in on the West Texas oil. I mean, shoot, even Saudi Arabia and Japan are investing in our natural gas here in Texas at this time. They know it's not going anywhere. And then we talk about investing. I mean, Occidental Petroleum, which is a publicly traded company, their largest investor is Berkshire Hathaway. Berkshire Hathaway, as we know, is owned by Warren Buffett. So if he's investing more now in oil and gas, do you think Warren Buffett, and he doesn't sell anything, do y'all think he thinks oil and gas is going away anytime soon?
Yeah, he's definitely a classic long-term investor, and kind of has his on the pulse. Yeah, I don't know if you had insider information there or not, Ben, but I know like in our real estate deals, which are also private placements, they are generally open, but it's the taxation and income laws are just different from country to country for everybody. And so there are different, like Canadians behave a little bit differently than people from South America. It can be done, but a lot of times the return has to really be there to offset transaction costs that happen in double taxation, as happens if you're U.S. investing somewhere else or things like that.
Yeah, I think
I don't know if it's the same for oil and gas, but if it's a PPM type investment or something where you're coming in and doing something like that, I would imagine it's fairly similar.
Mm-hmm.
Yeah, gold is definitely a global commodity, and the investors are global, as well as clients of Monetary Metals, people from Canada, United States, Europe, everywhere. Because at the end of the day, gold is money for everyone and has always been money for everyone. Indians, Chinese people, Americans, everyone actually is understanding the value of gold. And in some ways, I think Americans understand gold the least, simply because our currency has been the strongest, right? We've had to worry about it the least. 10% inflation for us is like, oh my God, everyone's hair is on fire. But most countries go, 10% inflation. What was that per month, right? Per month. And so, having such a strong, Argentina is a good example, having such a strong currency, a strong economy. And like Ray mentioned, just seeing gas prices go up a little bit had people freaking out to the point where people said, okay, maybe we need to get some gas flowing again. And so, gold in some ways is not loved as much as it is in other countries. But anyone can invest in Monetary Metals, global citizens. We're open for that. Of course, like you mentioned, obviously the tax implications and the different sales tax or import taxes do depend on your jurisdiction. But we also have partners in terms of vault partners across the world. So Brinks, Loomis, all those guys, those vaults, those depositories, you can call us up and say, hey, I'm in Switzerland, or I'm in I'm in somewhere in Europe, right? And we'll find a vault partner for you.
Nice. Well, we probably need to wrap this up here. Any final questions, observations from you guys for one another?
Or punches?
Low blows, whatever. Yeah.
I like Ray. I will never. No low blows. I can't punch my friend. We're definitely friends after this. I'm not an accredited investor, so until that happens, I can't invest with Ray. But I'm excited. Hopefully he'll be a client of Real Gold, and one day I'll be a client of Black Gold.
Yeah, right. And when you get that 20% per month return on investment, then definitely I want to be. Yeah, right. And when you get that 20% per month return on investment, then definitely I want to be the first one you call. All right. Well, we're going to take a quick minute here just to confer over what we've heard, and we'll jump right back with a champion announcement. Right on. Okay, guys. So we took a quick discussion here. I do see a place for both of these, honestly. I mean, as with most of the matchups we do, it's a question of risk tolerance versus, your return profile. And I think gold and oil and stocks and all of that deserve a place for anybody's healthy portfolio, because it just really, you need to hedge against some things. And I do agree with you, Ben, that I think here in the U.S., we have enjoyed such a robust and healthy economy with a lot of great investments that gold gets a backseat to all of these. So I think that's probably a fair assessment. But for this one, I think you can't beat the returns that Ray's pulling out, as well as the tax benefits on both sides of that. So we're going to go with black gold for the champion of this matchup fight. But like I said, both of these are some great investments. But
thank you. Very exciting.
Yes.
I don't know what to do with my hands right now. We can't complain. God is good. The oil and gas industry is an amazing place to be. And every now and then I get to put on a jacket and get to talk to great people when I actually don't have my work boots on.
Take off your steel toes.
So, thank you guys very much for the opportunity. This was too fun. Go oil. Yay, black gold.
Yeah, likewise. Go both of these. I like them both. But thanks to you both for coming on the show. We really, really enjoyed it. It was a lot of fun. It was very educational for me on both sides. Two investment types that I'm not super well versed in, but hope to be after this. So I'll make sure and keep both your numbers handy. But again, thank you very much. Super grateful, and appreciate you coming on the Cash Flow Fight Club podcast.
And for the listeners that are very inspired to invest with you, what's the best way to find you? Ray, let's start with you.
Oh, yes. Thank you. They can definitely go to pecosoperating.com, pecoscountry.com, or pecosoil.com. Also, I do have a great YouTube called The Crude Truth. And also I've got a LinkedIn and email so you could definitely email us at info@pecoscountry.com. So we'd love to talk to anybody that has any questions, and anybody out there that knows me, if they want to talk to Ben, let me know and I'll get y'all in contact with Ben.
Right on. Ben, how about you?
Okay, well, listen, if anyone wants to talk to Ray, I'm happy in defeat. We're going to be friends. He's going to meet me in California. Now he's going to buy me a drink instead of the other way around. If people want to find Monetary Metals, it's monetary-metals.com. I'm Benjamin Nadelstein on LinkedIn. If anyone wants to chat, DM, discuss gold, leasing, or just wants to hear me rant about economics, I'm always happy to do that. And again, it's monetary-metals.com. We'd love to see you.
Thanks again, gentlemen. Both of you, wish you all the best. Thanks for all you do for the community and for investors and making the world a little better place. And we hope to see you again on the Cash Flow Fight Club podcast.
For those of you tuning in, we thank you so much for investing your time with us on the Cash Flow Fight Club podcast. We certainly had a blast, received some knockout insights, all while learning something new. And we hope you did too.
If you had fun, please subscribe to the podcast wherever you watch or listen.
Lygia and I truly believe the beauty of cash flow is having your money fight for you instead of you having to fight for money. So whether it's one of these methods or something else, we encourage you to dream big and take action. See you next time.